This app is valued at $40 billion. It's on track to generate $3.5 billion in revenue this year, and as of last month, the state of Washington won a court order to shut it down entirely. Ohio already fined it $5 million. Arizona filed criminal charges. Minnesota made it a felony to even advertise it. Welcome to Kalshi, the prediction market platform that's either building the next Chicago Mercantile Exchange or running the most expensive legal bluff in the history of American fintech. By the end of this video, you'll understand exactly how Kalshi makes its money, why its business model terrifies every state gaming regulator in the country, and whether that $40 billion valuation is justified or a bubble waiting for the first Supreme Court ruling to pop it. Let's start with the money. Kalshi is not a sportsbook, at least that's what they claim, and that distinction is everything. A traditional sportsbook, DraftKings, FanDuel, sets the odds, takes the other side of your bet, and profits when you lose. It's called the hold, and it's typically 4 to 8% of every wager. Kalshi doesn't do that. Kalshi runs an exchange. You want to bet the Lakers win? You're not betting against Kalshi. You're buying a contract from another user who thinks they won't. Kalshi is the matchmaker, the referee, the toll booth, and the toll is where the economics get interesting. Kalshi charges a maker-taker fee. If you place a market order, an immediate buy, you're the taker, and you pay a fee that slides from roughly 0.07% to 7% depending on the contract's probability. An 80% probability contract costs 1.4%. A 20% long shot, 5.6%. Makers, people who provide liquidity with limit orders, pay nothing. In fact, Kalshi pays them. Rebates up to 1% through a tiered reward system capped at $7,000 weekly. This is the same model the Chicago Mercantile Exchange has used for decades. And here's why it scales beautifully. Every trade generates revenue for Kalshi regardless of who wins. The house doesn't care about the outcome. The house cares about volume, and volume is exploding. Kalshi processed $29 billion in trades in June 2026 alone. $7 billion of that came from World Cup markets. $7 billion came from newly launched crypto perpetual futures, which critically charge zero fees right now as Kalshi builds liquidity before flipping the switch. Sports contracts alone generated roughly 80% of fee-generating volume in mid-2026. Parlays, multi-leg bets that used to be 2% of volume, surged to 50% during the World Cup. That's not organic evolution. That's engineered product design aimed at maximizing transaction velocity. Every parlay leg is another fee. But trading fees aren't the whole story. In fact, they might not even be the most profitable line item. When you deposit money into Kalshi, it sits in a regulated account before you trade it. Kalshi keeps the interest. It's called float income, and it's the same trick Robinhood, Schwab, and Coinbase have. Used to print billions. With short-term treasury yields elevated in 2026, idle customer cash is a money machine. Kalshi even leans into this. They advertise up to 4.05% annual interest on balances to attract deposits, while pocketing the spread between what they pay out and what they earn on the underlying instruments. The more users Kalshi has, the more cash sits idle, the more interest they collect. It's a flywheel. Marketing drives deposits. Deposits drive float income. Float income subsidizes lower trading fees. Lower fees drive more volume. More volume attracts more users. Rinse and repeat. With 2 million monthly active users and climbing, that float is not a rounding error. It's a core pillar of the business model. And then there's the third revenue stream most people don't know about: data. Kalshi's prices have become reference points for the entire information economy. Bloomberg terminals display them. CNN and CNBC partnered with Kalshi in late 2025 to show live prediction odds across their programming. Hedge funds pay for historical data and real-time feeds. API access for institutional traders commands premium pricing. When your platform becomes the definitive signal for what the crowd thinks about elections, sports, and macro events, the data itself becomes a product. So where does the money go? Running a federally regulated exchange is not cheap. Kalshi spent 6 years getting CFTC approval, 6 years of legal fees, compliance infrastructure, and regulatory lobbying before they processed a single trade. They now operate their own clearinghouse, Kalshi Clear LLC, launched March 2026, which removes reliance on third-party clearing but requires massive capital reserves and risk management systems. They're a designated contract market, which means they self-certify new products without prior approval, but that also means they bear full liability if the CFTC later determines a market violated rules. Then there's the war chest for state litigation. Kalshi is fighting legal battles in at least 10 states simultaneously. Arizona filed criminal charges. Ohio fined them $5 million. Washington won a preliminary injunction in July 2026. Minnesota passed a law making it a felony to host or advertise prediction markets. Nevada's Gaming Control Board sought contempt citations for allegedly failing to geoblock users. Massachusetts forced them to implement geofencing for sports markets. Every lawsuit requires outside counsel. Every state ban requires engineering resources to build geolocation fences. Every appeal burns cash. Kalshi has raised $1.7 billion in funding to date. A significant chunk of that isn't going to product development. It's going to staying open. Here's the paradox that makes Kalshi fascinating. Its greatest competitive advantage is also its greatest vulnerability. Being CFTC regulated allows Kalshi to operate in all 50 states without obtaining individual state gaming licenses. DraftKings had to negotiate with 38 state regulators. Kalshi bypassed all of them with a single federal designation. That's why they can offer sports contracts in California and Texas, states where traditional sports betting is illegal. It's a regulatory arbitrage play worth billions. But that same federal standing has united state attorneys general, tribal gaming authorities, and established sportsbook operators against them. California tribes allege Kalshi violates the Indian Gaming Regulatory Act. State regulators argue that event contracts on sports outcomes are functionally indistinguishable from wagers, and they have a point. Kalshi's own attorneys wrote in a 2024 filing that sports contracts were precisely what Congress had in mind when it banned gaming contracts. A year later, Kalshi launched Sports Markets anyway and marketed itself as the first nationwide legal sports betting platform. The political layer makes this even messier. Donald Trump Jr. is a strategic advisor. Brian Quintenz, Trump's nominee to lead the CFTC, sits on the Kalshi board and owns stock in the company. The NFL, NBA, and MLB have all written to the CFTC expressing concerns about game integrity. The Senate recently voted to ban senators and staff from using prediction markets entirely. This isn't just a business story. It's a constitutional tension between federal and state authority, between financial innovation and gambling regulation, between tribal sovereignty and tech disruption. And Kalshi is the battlefield. So is Kalshi worth $40 billion? Let's compare. CME Group, the world's largest derivatives exchange, trades at a market cap of roughly $75 billion and generates $6 billion in annual revenue. Kalshi is asking for a valuation that's more than half of CME's on 1/20th of the revenue and a fraction of the regulatory certainty. The bull case is that prediction markets are a trillion-dollar asset class in the making. Bernstein estimates the sector will hit $240 billion in volume this year and $1 trillion by 2030. Kalshi has first-mover advantage in regulated U.S. markets, partnerships with Coinbase and Prize Picks spanning 38 states, and Clear Street, the first institutional futures commission merchant, joining in May 2026 to bring block trading and ETF issuer workflows. If institutions adopt event contracts for hedging macro risk, Kalshi's volume could compound for years. The bear case is simpler. One adverse Supreme Court ruling, one CFTC policy shift, or one federal law reclassifying sports event contracts as gaming, and Kalshi's entire moat evaporates. They'd need 50 state licenses overnight. The cost would be catastrophic. The valuation would crater. Kalshi's economics are undeniable. The exchange model scales. The float income compounds. The data monetization is just beginning. But this isn't a company being valued on cash flows. It's being valued on regulatory optionality. The bet that federal preemption will hold, that states will lose their lawsuits, and that prediction markets will be grandfathered into the financial system before anyone can stop them. That $40 billion valuation, it's not pricing Kalshi as an exchange, it's pricing Kalshi as a political outcome. And if you're investing or trading on that platform, you need to understand that your counterparty risk isn't just the person on the other side of your contract, it's the entire American federal system. Before you deposit another dollar, ask yourself, are you betting on sports or are you betting on the Supreme Court?